Hello and welcome to the Market Expert Year in Review, but also look forward. I'm Zach Strickland, head of Freight Market Intelligence here at FreightWaves. I am joined with Mike Bowdendistel, Ryan Grody, and Tony Mulvey, all experts in their respective field of intermodal supply chain, macroeconomics, and a little bit of trucking. A little master of all over there, but we're going to talk about what we've seen in the market this year, parse some of that data, but also apply what we've learned forward and start breaking down what we expect for 2025. It has been an interesting year. I don't know that it's been that volatile for most transportation service providers, but I think Craig Fuller, our founder and CEO, declaring the end of the freight recession has created a little bit of a stir in the environment. I think a lot of people are saying, yes, they can tell, they can feel it, but there are some out there that are holding out saying like, no, not so fast, my friend. But to get things started today, I want to turn to Tony Mulvey, who is my co-host on the Freightonomics podcast, and ask you, sir, what have we seen that supports that we have ended the freight recession?
I think the thing that supports ending the freight recession is just the direction of tender rejection. So looking at the outbound tender rejection index, really bottomed out in the May of 2023 and has been trending higher, not without some volatility along the way, but you've seen it throughout the entire year of 2024. It has been higher than where it was in 2023. I think what really signals it is when you start looking at what's happened from September onward through now is this steady trend of higher and to the right. You look, we've got 2019 up here kind of for reference, just for similar environments coming out of our freight recession, kind of the end of 2019, marking the end of that one into 2020, it was creating a tighter environment. I think if you look at the trend line there, again, September through now, it's stable and higher to the right. Like you mentioned in the open, doesn't feel a whole lot different for transportation providers. The difference in, call it 4 or 5% to 6% is not significant, but I think it's the fact that this is trending higher. You should be trending higher seasonally, but it's breaking out from where it was a year ago. I mean, you look, that gap between this time last year and now, it's widened compared to where it has been most of the year. And I think that's really one of the signs for bullishness heading into, call it 2025.
Yeah, I think this chart right here does a good job. It's actually a little bit of a breakout of seasonality too. We've never really traditionally seen tender rejection rates increase as steadily from September into December as we see here. Typically, we see a bit of a spike around Labor Day that retracts. We actually almost caved in around Labor Day a little bit and then started the increase. So, Ryan, I want to turn to you here, and from a shipper perspective, supply chain perspective, what does this data say to you about moving forward? Like, what are the expectations here?
Yeah, I mean, the expectations moving forward into 2025 are, from a shipper's perspective, definitely expect a tighter market going into 2025. We know a lot of shippers today are currently in the bidding process with RFPs, or they're considering launching those in Q1 of next year. And I think just what this chart's displaying is that do not expect the easy procurement capacity that you've had the last 2 years. Going into 25, we're going to see that right size of capacity, and there are going to be those pockets of volatility. And so you'll definitely need to be conscious of that when pricing freight, procuring that capacity.
Yeah, I tend to agree.
And I think he said something there, the pockets of volatility. I think you're seeing it show up right now. I mean, there's areas in the country that are seeing, depending on where you're shipping things out of, like your exposure right now is there. I mean, you wrote about it in Daily Watch, Zach, this week, looking Pacific Northwest around, Christmas trees and things like that. Like there are, depending on what you're shipping and things like that, the pockets of volatility are already arrived, right? So it's, when you look at 2025, odds are it's going to be more volatile than it is now. And then, so they're already showing up, and it's going to get increasingly volatile as we go to that. And I think that's where you get to, call it middle of next year, and you can see a very different market than where we're currently at.
And Mike Bowdendistel, our intermodal and also now ocean expert, intermodal, the import situation has really driven a lot of intermodal volume growth, as we've discussed. And it's also had a pretty big influence on the freight market this past year. Can you speak to kind of the experience to this point of what's been going on with the rails and intermodal? I think, I've written an article or two about the intermodal kind of keeping a tamp on the truckload market from really having a breakout, what I would consider a breakout. Do you think that's true? And then what do you think about how the import volume and the tariffs and all that moving forward may influence this market?
So the high degree of imports has really been the story this year. I mean, you saw a lot of the ports around the country breaking records, particularly on the West Coast. The Port of LA talked about breaking import volume records a few months in a row. And so not only do you have a large number of imports, but there's been a change in the pattern of where those imports are coming in from the East Coast, which had been growing the past several years towards the West Coast. So this chart we're showing is a favorite of the Class 1 railroads that are SONAR customers, as well as Wall Street, because it's forward-looking. It's looking at shipments at the point of origin, often China, that are coming in for U.S. imports. And the 2024 is that blue line. You see how it's exceeded last year, which is 2023, in pink, all year long by a fairly wide margin. And during the middle part of the year, people were thinking, well, we're pulling forward what should be moving in the fall. Now that we're sort of close to the end of the year, people are saying, well, now we're pulling forward what should have been moving next year. It's just there's this surge of imports ahead of the tariffs. So more goods are coming into the country, I think trying to mitigate some of the risks associated with ocean shipping. You've seen the Red Sea situation really elongate supply chains. Doesn't look like that's going to be fully open anytime soon. Those attacks are continuing. So there's been a shift, I think, to the West Coast ports. That is translated into intermodal volume because intermodal is concentrated in certain key corridors. And the volume that came in, is just very compatible with intermodal volume. So here we're looking at domestic intermodal volume, and you just see how that's risen specifically towards the end of the year. Now that's really done a lot better than long haul truckload volume outbound of LA. And part of the reason for that is the carriers have incentivized intermodal volume. I've heard from a lot of shippers that have not used intermodal in the past, saying some of these domestic intermodal companies calling them up saying, we want to put these containers to work. Can we interest you in intermodal? You've seen some pretty aggressive rates to get them to do that. So it's kind of this inertia where it's hard to get shippers to use intermodal that first time, but when they use it, they have a good experience, they'll come back. So it does seem like it's taken some share from truckload, but a large part of that is it's been in those corridors from, let's say, LA to Chicago, LA to Dallas, which are just very compatible with intermodal.
Mm-hmm. Do you think the intermodal situation here is sustainable? I mean, look at the chart here. Domestic growth is exceeding that of COVID, and that's kind of the period where it broke, the infrastructure broke. Are the same concerns still present?
Yeah, so we took 2020 off of that chart, but when 2020 is on that chart, it's trending right along where 2020 was for this time that year, with much better service levels than we saw at that time. You're right, the infrastructure broke at that period of time, but we've really seen strong service levels this year. By and large, shippers have been satisfied with the service. So there's been a lot of investment both in the containers by the domestic intermodal companies and also in a lot of the terminals and infrastructure by some of the Class 1 railroads. Some of that investment was coordinated between those parties. So I do think there's evidence that intermodal is a growth area again, and I do think it's sustainable and can have another step up.
All right, Ryan, I want to turn to you here for a bit, and I want you to speak to kind of like as a supply chain manager. Intermodal tends to have a little bit more volatility in it in terms of like ability of service.
Yeah.
You have to have multiple touch points, along the way, and sometimes it's considered almost like moving storage to an extent for a shipper.
Yeah.
And inventory costs are on the rise, as we well know, but is there a component here, like, does this tell you that a lot of these supply chain managers are pulling forward and really the sense of urgency isn't quite there yet?
Yeah,
and
absolutely.
Tariffs are having a bigger influence here? Yeah,
and that's something Mike and I talked about previously, but that pull forward of a lot of this inventory has given them the leadway to where the sense of time and urgency and getting product to market isn't there yet. And so they're able to still elongate the supply chain, ship it on the rail, at a cheaper cost because it's been that pull forward. So it's not that just-in-time inventory replacement that has allowed them the flexibility to pull that forward.
Yeah, so Mike, I think intermodal has an advantage in cost necessarily, and there's a little bit of a trade-off in service. Do you think that, I think a lot of the major carriers or providers have signaled rate increases. Do you think that this may inhibit some of that growth?
I think it'll follow the truckload market to a certain extent. I mean, we have rolled out a couple new data sets. One is this intermodal contract rates, and we produce those in 67 lanes. But we also had the data team look at those and a couple of different aggregations. And one of those aggregations is that blue line, which is the transcontinental index, which is an average of 5 dense lanes that are leaving Los Angeles, so LA to Chicago, LA to Dallas, et cetera. And you see there, like most of the rates, they've been down a couple of years in a row. Those are more, more protected from the truckload market than what I call the local east lanes, which is that green line, which is an average of 9 lanes between Chicago and points eastward that are also dense. And so, if we have a situation where the truckload market tightens, I do think you'll see both of those rates increase for both of those indexes, but the local east ones, those are more competitive with truckload. Those will rise more than the transcontinental lanes just because it just follows the truckload market more. They're going to be more volatile on the upside as well as the downside.
Yeah, potential for a little bit of, I don't know if erosion's the right word or not, but a little bit more breakdown and share. Tony, I want to turn to you now. I'll turn back to you and get a little macro as we normally do here. So I think a lot of the assumptions here, we've discussed that the market is tightening, and that's really a supply side situation. We're seeing capacity come offline dramatically. The intermodal side is kind of handling some of this volume, tamping that down a little bit, but this is largely a supply side event that we're seeing. Are there any concerns for you over the next year? Because I think we've talked to several people now that have concerns about demand.
Yeah.
And of course, Trump being reelected president has people concerned about inflation from tariffs and all this kind of stuff. What is your position in terms of how do we regard demand next year? Is it stable? Are we looking at an up and to the right, or what is it?
Well, I think there's one thing. I mean, if you look at the past Trump presidency, what did he do? He stimulated the economy, right? And that's demand positive. But I think there's some issues. Like if you do get another round of inflation with tariffs and the like, I mean, the one thing that the Fed's going to do in that situation is there one lever that they can pull to fight inflation? It's raising interest rates. And I think it works two ways. You're having a Fed right now that's cutting rates, which should help boost demand because it frees up capital to invest in. But the question is going to be is if you do get another round of inflation, does that lead to elevated interest rates, which it kind of works in the opposite, right? It kills demand to some degree. So I think it's what happens over the next year. I mean, I don't want to say it's largely what the Fed does. I do think as we move into 2025, you're having signals that lower interest rates, at least in the short term, are coming. I think we've got one more Fed meeting this year. We've already had 75 basis points in reduction of the Fed funds rate this year, potential for another 25. So you're talking basically a whole percentage point off the Fed funds rate. Frees up capital for companies to spend and invest and help boost really the manufacturing and industrial side of the economy. It's really been a laggard. Really what's carried the freight economy forward has been the consumer side of the economy. So I think you're getting to the end of a consumer-driven economy to some degree. Will always be that way in the US, but I think what you might see in 2025, at least again, in the first half of the year, where these interest rates have become lower, is you're going to have an industrial side of the economy that shows maybe some sign of life that it really hasn't. I know we had a chart looking at the PMI, the Institute for Supply Management's Purchasing Managers Index, kind of a gauge of that manufacturing sector. I think what's interesting is you look at it, like the downside of this, call it the last 2 years. I mean, 23 of the last 24 months, the industrial side of the economy has been in contraction. Compare that to 2008, 2009. It's a longer period of time, but not as steep. And I think that's interesting when you look at it, that if we get a boost to that side of the economy, that's going to help drive demand in the truckload space that really has been lacking for the past, 2.5 years at this point.
Yeah.
So Ryan, I want to turn to you now and ask, what are your thoughts here? If you're a shipper in this space, you're kind of tamping down. You've got a lot of geopolitical risk out there, obviously. So supply chains are currently reevaluating or a ongoing transition to something to hedge their bets against further confrontation, conflict. Obviously, we're not getting along with all the countries effectively. What are your thoughts on potentially that geopolitical influence here on demand or maybe even some level of supply?
Yeah, I mean, we've heard from a lot of shippers, there's the buzzwords of reindustrialization and nearshoring, and we're absolutely seeing that and having those conversations with the shippers that we've been talking to and wanting to bring some of the supply chain back as a hedge against any type of geopolitical risk. I think if we have the chart too, we're seeing warehousing capacity and prices increase at the same time, both in expansion, and that's just telling you that there is this capital expenditure that's going towards building out warehousing capacity within the country. We've seen a ton of government stimulus in the chip sector specifically, but a ton of mega manufacturing warehousing space in the Sun Belt. And so there's certainly a lot of shifting of supply chains with the backdrop of thought that geopolitical risk and relationships are certainly changing.
Yeah, I mean, there's been this ongoing effort of like saying, okay, we've had, the tariffs are a concern, but we had the Red Sea confrontation or conflict over there. Is there something you think that we're not thinking about here in terms of like what might influence domestic freight flow or international freight flow at that over the next 12 months?
The one thing I do like to talk with shippers about and really kind of relay to the broader industry is that while supply chains are shifting, it is like moving a slow turning tanker ship. I mean, they're not going to change overnight.
Yeah.
And shippers are always trying to find best quality, cheapest price, best suppliers. And, grass might not always be greener on the other side of the fence. And so those conversations are being had, maybe moving some of that supply chain from China to Mexico, for example. But then there's still a risk, Trump's even announced tariffs coming from Mexico inbound. And so it's a game of questions for the past decade, typically in the U.S. and consumerism. Number one trade partner has been China. Right. That's starting to decouple, but now it's going to, the question is, who's going to rise to the top in terms of top trade partner? Is that just going to stay China? Is that going to become Mexico? A lot of shippers are starting to ask those questions and really trying to understand what the future holds.
Yeah, I would add another thing that's changed has been some of the congestion at the ports around the world. Go back to in the summer, right about the time we had our Atlanta conference, which was late May, early June, there started to be reports of shortages of international containers that go on the ocean carriers. And part of the reason for that was there was congestion at the port of Singapore, which serves as a hub. And it really started to put a wrench in some of the international supply chains. And so I think that caused a change in mindset with some of the shippers that they have to ship the products early. And I think it's changing some of the typical seasonality combined with the Red Sea situation, which if you really are going around the port, going around Africa, the Cape of Good Hope, in order to get goods to the East Coast, that adds an extra 2 weeks for those shipments. So in terms of what's the typical impact, when is it going to happen for the Chinese New Year, you have to think about that happening sooner, but potentially right now, even as shippers are getting imports to avoid the tariffs at the same time.
Yeah, so we've got Lunar New Year coming up here in February or end of January. I don't know exactly which day it is this year, but is there a potential here that could create some level of unforeseen disruption in your opinion? Because normally we see imports kind of flood the market like we did last year, but it really just ended up being like this flood into warehouses. Do you think some of that spills over because it's been building for so long?
I think so. I mean, I think the warehouses are rising. I think in order to get the goods shipped by Chinese New Year, I mean, it depends what the product is, but oftentimes it would already have to be ordered or ordered very shortly in order to have it shipped out in time. So, I do think it's going to have a big, impact. And I think there's a lot that has been imported that is maybe imported a little bit early, sitting in those Southern California warehouses or even moved inland via intermodal, like you alluded to, earlier, less time sensitivity gives an advantage to intermodal. We've seen a lot of that. But then a lot of goods in those sort of upstream warehouses still a little bit further from consumption centers. So there still is, I think, some pent-up demand to move those closer to the consumption centers.
So Tony, we were having a conversation with Dr. Rogers earlier regarding some level of expectation from the shipper side, and that he, of course, is one of the main authors of the LMI. And I want to get your thoughts here on, how supply chain managers, from a macroeconomic standpoint, should potentially view what's going on with all of this inflation and their expectations for consumer demand next year. What do you think some of the strategies are that might influence how shippers bring freight into the country next year? And maybe there's some false signals here.
Yeah, I mean, it's hard. I mean, you look at the LMI. I mean, I think one of the things, the expectations are obviously for higher prices. But then you break it out and you start looking deeper in that, and you look, call it upstream and downstream, and go away from price and look at capacity. And we have a good chart to look here at the signals that the LMI presents. I mean, here we've got price, transportation price in the white line, and then capacity in the orange line. And you kind of see the inflection points of these cycles. Very different cycle kind of turn or signal that we're turning. It's not quite as extreme as what we saw in 2020. But I think the takeaway here is you start looking at it. Expectations are for higher prices, but capacity growth, which I think is interesting, but it's very bifurcated. Downstream firms, so retailers, are expecting pretty exorbitant amount of capacity growth. And from my perspective, I don't know if that's a factor of they expect carriers to come online and this lacks capacity that's kind of been hanging around the market to still be there, or if it's a factor of, hey, we don't necessarily know if our demand is going to be maybe as strong as it has been recently, and relative to what that's going to be, that capacity is going to grow transportation capacity growing relative to their demand. And I think that's interesting. But I think I look at this chart and I see things are changing. Prices are likely to be higher from a retailer perspective next year. And if you want to be in front of it, you don't want to be at the bottom as prices start to rise, because at the end of the day, once they start rising, like, your costs are going to go up and your budgets get thrown out into disarray. And at the end of the day, you're going to have to answer for why that was the case. So I think, expectations, you start looking at some of these charts for 2025, you should be budgeting higher transportation costs.
Brian Grody, agree, disagree?
Agreed.
Hot take?
No, hot take, absolutely agree. And I don't know if we can cycle through, but we have the same LMI for warehousing. And it's showing the same thing that Tony was just touching on with transportation. Is the expectation is that capacity is growing in the transportation or in the warehousing space, but then also warehousing prices are also climbing as well.
That's inventory levels.
But yeah, it's this expectation, plan for higher budgets, both in transportation and in warehousing.
So I want to push on you a little bit and say, wait a minute, why would I plan for higher budgets when I'm expecting some level of demand reduction?
Again, it goes back to, this has really been a supply side freight recession. It's been too much capacity in the market. That's been bled out, and now we're seeing an equilibrium find. So regardless of that demand, supply has left the market. With regards to warehousing, we're seeing a bunch of pull forward, and so warehousing capacity is having to grow. But it's really no longer that question of too much supply. It's finding that balance.
Well, I think it goes into, growing with the economy too. I mean, as the economy grows at 3% and demand grows at 3%, I mean, you're still seeing demand growth. And I think that's overall, and likely, hopefully, see goods demand grow at a rate faster than the overall economy. I mean, it leads to, demand doesn't have to grow at 10, 12, 8%. It just needs to be stable growth as you're seeing capacity reduce, and that causes higher prices.
And we found the warehousing chart for you, Ryan, if you want to jump in on this, because I think one of the questions I've been getting has been, well, inventory costs are high. So holding on to these costs are getting worse and harder. How does that influence just-in-time versus just-in-case inventory management this year?
Yeah, I mean, I think looking back to COVID, shippers at the time were really striving towards that just-in-time model, right? Like Toyota kind of set the precedent there. Everyone wanted to be just-in-time because of inventory holding costs. COVID shut down, inventory holding went up through the roof, right? Inventory to sales ratios went up. Luckily, then government stimulated, consumers started to purchase and bring that inventory holding down. But it's certainly something that needs to be on the radar of shippers moving forward, because if we do see slower growth, even if it's growth, these warehousing prices are increasing even as capacity is increasing, which tells us that there is tightness in the warehousing space. And so that's something that they do need to be mindful of, and wanting to get that product moving through the warehouse so that they're not experiencing those holding costs.
Yeah, because fluidity in the supply chain is very challenging right now. I mean, because you can't just throw things into spare warehouses anymore that are laying around. You've got intermodal, which has been kind of like I alluded to earlier, a little bit of a moving storage situation. Especially, it's very convenient when you're pulling stuff in overseas in containers, and they can just stay on containers and move across the country on the rail. But Mike, what kind of factors do you see showing up this year for the intermodal and rail side? Do you think that there's going to be a situation where that, we talked about the infrastructure kind of having no foreseeable boundary right now, but do you think that if we continue down this path, especially if warehousing becomes more expensive and less of an option, do you think that intermodal still is able to maintain this level of resiliency?
Well, I do think you'll have disruptions if volume continues to grow. I think this past year there was seemed to be plenty of capacity most of the time, and so you really didn't have those types of issues. And like you said, I mean, for a large part of the shipments, it just really weren't time sensitive. So the typical truckload plus 1 day or truckload plus 2 days was just fine. And I think when things get a little bit more time sensitive, the service bogey, if you will, gets ratcheted up. But certainly I think the industry, is thinking about sort of what happened in 2022, which is, they didn't have enough, chassis. There weren't enough space at the various terminals to stack the boxes. There wasn't enough drayage capacity. There was just, it seemed like what could go wrong did go wrong. And in the last several weeks, there's been some congestion in the international intermodal sector, near the ports of LA and Long Beach, which has actually helped domestic intermodal a little bit, caused a little bit more transloading. So starting to see some indication of that, and we'll see if the railroads continue to be as motivated by good service levels. I mean, intermodal is not one of the sectors that is regulated by the STB, the Surface Transportation Board. It's exempted from their oversight because it's deemed competitive with truckload. But nevertheless, the STB cracking down on railroad service levels the past couple years, I think had a big impact on how they approached service overall. And the last few quarters, you've seen, because intermodal has grown so well, particularly international intermodal, you've seen some dilution in the operating ratios because of that negative mix impact. So you do think that the railroads are going to want to get to having 60 OR and below sort of across the board, and maybe that means they don't spend as much cost on spend as much capital on the network resiliency or as much cost to have enough personnel in place. So I do think it's a risk.
Yeah. All right. So I want to get back to the trucking market here. Tony, I'm going to turn to you. We've got the National Truckload Index line haul only pulled up here that I want to discuss for a minute here. This is, of course, the average spot rate for dry van loads moving across the country, long haul freight centric, but it's more than 250 miles. We're seeing something interesting develop here in the last bit. It's basically a situation where we're seeing spot rates now go the other direction. It's like, I'm not going to call it the inverse of 2022, but yeah, the white line you see there going above the green line for our audience, that's the current year going above 2022, which is the green line. This appears to be, another piece of evidence that the truckload sector is
responsive,
getting out of tightening.
Yeah, my take is that you look at it, it started moving higher kind of right around maybe a week to 10 days after rejection rates started moving higher. And I think that's my takeaway, is that look, rejection rates are going to lead where spot rates go. And we're in this period right now that you're going to see like tightness happen in the market. I mean, drivers will come offline, and that pushes prices up when you limit capacity. And when I think about that is like we're setting a higher baseline as we go into the final parts of this year. And then you go into 2025, which appears, again, to be a tighter market. You're going to feel some impacts from the first quarter, January, February. But you're likely going to be at levels higher than where we've been at any point in the last 2 years. And I think that's what sets up for, again, higher prices come next year. And these are really, when you think about it, it's the bottom of the market. I mean, it's like the area of last resort is sending freight to the spot market from a shipper perspective. So it's going to be, and from a carrier perspective, they effectively race to the bottom because those that are operating just need to keep moving, so they're willing to take rates. So as you get into a tighter environment, momentum can move in this very similar to it did on the way down. It can happen on the way up, like it did in 2020, kind of middle of 2020. It happens very quickly. And what does that do? At the end of the day, it leads where contract rates are going. And I think that's
leads
where
to the next,
yeah, it goes to this chart is looking at the initial reported dry van contract rate. It excludes fuel for
the
some degree.
VCRPM1 versus NTIL12.
Yeah, so
for the SONAR users.
Some little measure of fuel in the spot rate, but I think it highlights how much earlier spot rates move. I mean, you're talking, some cases 90 to, on the way down, it was about 120 days. So it was a little longer. On the way up, it moves a little more in line, but I mean, you're still talking, call it 30 days at least. But I think what you're seeing is if you look in that yellow line, think of that as you can call it a carrier to, or a shipper to broker contract rate equivalent versus the white line, which is more shipper to carrier direct relationship rate. What you're looking at is if you look at that yellow line, the bottoms, each low is trending higher. And I think that's the signal moving into 2025 that you're going to see higher rates, is that each kind of cycle signal of, hey, we're bottoming out, moving higher, they've been higher for really dating back to May of 2023. And as we enter 2025, if that continues, I mean, it's eventually sets the market for contract rates to move higher. I think the other element is that if you looked at the average of the second quarter versus the third quarter and the VCRPM, the white line, it was higher in the third quarter than it was in the second quarter. It's really the first time that's happened in quite some time. And I think that's, again, another signal that higher rates, I mean, I'm not going to get up here and say how much higher they're going to go, but the rate concessions or rate declines seem to be a thing of the past.
Yeah, I'd like to hear your take on this too, Ryan. Like, I think in my mind, you could almost say the end of the freight recession happened almost a year ago, because of the way that yellow line was starting to rise. Now, contracts were still coming down over that period of time, but you see the delta here.
Yeah.
There was, like, the spot market itself represents a level of, negotiation. Mm-hmm. That's the most heavily negotiated space in the market. So therefore rates are accessing more backhauls, there are more carrier, wider nets there. Whereas the white line there is really about a shipper trying to consolidate a lot of their carrier bases.
Yeah, and I think conceptually that's why it's hard for some of the market to accept that the bottom was May of last year, because they said, well, contract rates are still falling, right? This is clearly not a recession, or the end of the recession if I'm getting priced lower by the shipper. But we all know that those contract rates are going to move slower. And I think Tony called it out perfectly here. We're actually seeing price appreciation in contract rates already, as this gap, the spread between spot and contract, are already increasing. And that's exactly as you put it, 70% roughly of freight still moves in the contract space. And the fact that we're already seeing those prices start to appreciate or inflate, I think is just another signal that the bottom of the recession is in the past, and we're now in a tightening cycle.
Do you think this is really a situation where, because I mean, I've talked to plenty of people, there's still plenty of available capacity. Do you think that there's some level of expectation being baked in here? Because you've got the 12-month rates, there's still room to fall according to the spot market.
Yeah.
But you've got this 12-month rates already starting to turn. And if you look back to 2019 here, it really took a lot tighter of a spread. You know, Craig loves to talk about the spread between spot and contract. And we really haven't reached the threshold until just recently where that would be tight enough to push rates higher on the contract side.
Yeah, I think there is, I like to believe that SONAR users, SONAR shippers, using the data, they see those spot rates increasing, and so maybe they are planning proactively for the future. But there's also this realization or expectation that costs have increased for a carrier, right? 30% up operating costs from 2019, and so we're never going to reset to those lower levels that we saw pre-COVID.
Right.
And carriers are starting to just put their foot down on the floor and say, look, my operating costs are 20, 30% higher. And so I think the new spread between spot and contract is really where we are today. And it's starting to cause shippers to already reprice some of their contracts higher. We're having those conversations. Some shippers are already having to put out mini bids and reprice some of their freight that's already experiencing service degradation.
Oh, really? Is there any specific regions or any sectors that you've noticed?
I've had a lot of conversations with some retailers, no specific geographies, but some retailers are already saying, hey, we're having some pockets in our network that are experiencing some issues, and so they go and they're already putting that freight back out to bid.
Interesting, fascinating. So I want to pull back to, the sector component here. We just talked about a lot of the high level things, but, it's Christmas tree season right now as we're speaking today. Of course, it's kind of coming to an end, but I want to talk about some of the different segments of the freight market as well as the economy, because they go hand in hand. And I've pulled up the van outbound tender rejection index, the VOTRI, with the ROTRI and the FOTRI for refrigerated and flatbed sides of things. And if you look at this chart, the white line, of course, the van, much slower, and of course that's the more dense. That represents roughly 60 to 70% of the total tender data. Refrigerated around 15-ish, 10 to 15-ish percent. Flatbed is some variance therein. So they're going to be more responsive, but I think there's still a meaningful difference between the increases in the refrigerated and van sides.
Oh, there definitely is. I mean, I think you look at the reefer side and that green line, I mean, it bottomed out. I mean, we're talking sub 5% in May, and we're pushing 20% in early November. I mean, that is a true breakout kind of experience. And I think it's one, size of the market has something to do with it. I mean, if you lose capacity when we're back in May and 5%, I mean, rates were challenged and the like. And I think that's part of the reason. I think what was interesting is if you looked at the spot rate on the reefer side, it was actually moving down as the market was tightening. And I think it was a factor of carriers not willing. It goes back to Ryan's point he made just a minute ago, where carriers are kind of like putting their foot down and be like, we're not moving it at this price. And I think but somebody out there has been willing to move it. But I look at this and it's like, okay, the reefer side, again, consumer to some degree, right? Holding up. Flatbeds kind of had its moment. I mean, I look at the spikes in October. You had 2 hurricanes really driving some of that. And I think when you get lower interest rates, that could be another driver driving some of that activity. And then I look at the van side, it's still up and to the right. It's just not the same scale. And I think that's the flip side is it's moved higher from its bottom, call it in May, when we're talking 2.5%. I mean, it's doubled in that time. Again, it's 5% or so right now, but which is still moving higher, right?
But it's still relatively low in the van side. And you can see, I think the interesting thing here is that refrigerated has gotten tighter towards the end of the year, significantly tighter.
Well,
and that's what's driven the aggregate index higher more so. While it's van, it was actually tighter around June, July.
Yeah, and I think what's interesting as we look into 2025 is the reefer side can be more volatile, especially earlier in the year because of cold weather, protect from freeze, like different things like that can impact it. Then you get produce and the like that can really create some volatility in the reefer side. I think that would be the area I would look to early in the year. If you're a shipper, that would be where if you do move reefer freight, like that would be the area that you're probably seeing the most exposed right now. And then you look at the van side, it tends to pick up in the middle of those summer months. So I think it's, from a carrier perspective, I think it kind of depends on where you operate. If you're a reefer carrier, you're probably looking at things that, okay, we're kind of getting out of this really, if we're where we're at right now and then moving into 2025, odds are the first half of 2025 is going to be much better than the first half of 2024 was. I think if on the van side, you're really kind of in line with where we were in the first half of, well, really the first quarter of 2024. If you don't see some meaningful movement, I think that's the case for more exits, especially earlier in the year on the van side, which I think is definitely happening. If you start looking at some other data, like former Bank of Montreal's data, you look at the LMI and things like that, I think odds are you're going to see continued exits, and it takes some time for that to really manifest itself. I mean, the rate of exits has slowed down from where it was, but they're still happening. I mean, they're happening to what, kind of mid 200s on a authority level. Now the challenge is, what does that actually mean for dispatchable capacity in the market? Because an authority can be one truck or it can be 1,000 trucks, and it's really hard to tell. But I think exits will continue to happen. I think you would have to have some meaningful rate increase from a spot rate or contract to stop or slow down that wave.
So rates haven't necessarily increased enough.
Yeah,
I was just going to ask, I mean, is the difference between those three sectors, van, reefer, flatbed, mostly a function of the capacity that came into the market during COVID was all or predominantly dry van, and so that's the sector that's oversupplied, that's where the capacity needs to come out?
I think to some degree, yes. I mean, one, you start looking at equipment cost. I mean, from a van versus reefer, just the sheer cost of the equipment does impact that. I think the flatbed side's probably the most interesting because it's not a lot of contract freight. It's more project freight, so it's naturally going to skew itself higher than what you would see on the van side. But I think as you get into, what's interesting is that it's elevated now, which just tends to be like the time you wouldn't see a lot of these projects. You see them in the summer. So I think that's one of the factors as you head into 25 and potential lower interest rates that creates a boost there. It's a little more burdensome from a driver perspective because at the end of the day, they have to strap the things down. So I think it does have a lot to do with that. Just is where that capacity came in and remains in now.
So what's the risk of a snapback? Like we had that occur with the refrigerated sector in the spring last year when everything should have been moving up and to the right. Our refrigerated outbound tender rejection index collapsed. You know, we had that crazy polar vortex type event in January last year where, you know, supply chains basically froze. And then all of a sudden we had this little mini return to a freight recession for the refrigerated sector specifically. Is that flushed out? Do you think that we've seen enough from the market to say that, okay, now's the time that the refrigerated sector is fully flushed?
I think the way the market's reacting right now seasonally kind of lends itself to say yes, that the risk is kind of falling back into that recessionary period for the reefer side is kind of past. I mean, it's always there. I mean, you could have risk from the demand side that I don't think has been mentioned quite yet. Like there is some risk on that front that can send it back. But I think from a supply side or capacity front, like it seems like that's been fleshed out because again, it's become more responsive throughout. It's not just a seasonal. It's been moving higher for the last 6 months, not just the last 6 weeks.
In a more sustainable way.
Yeah.
Yeah, and I think it is safe to say the bottom's in. We might see a bit of a depression, maybe in rates and rejections fall back, but by no means are we going back to the lows of May of last year. Because we've had, you know, historically this has been, the longest recessionary period in freight, 24, 25 months.
Well, I mean, the chart that I have pulled up here, I think helps explain this a little bit. You know, it's the capacity, it's the carrier details, net changes in trucking authorities with the LMI capacity index there that measures expansion or contraction in capacity. We're seeing we're still seeing, you know, the reds are, of course, where we see net changes in the negative. Greens are positive. We're starting to moderate a little bit.
Yeah.
Ryan, you know, we just had a big, dip here in the last bit, but Thanksgiving, it is government data, so they have some administrative stuff that inflates these figures, but I think we're still largely seeing a huge bleed off in capacity. Do you think that this is still going to be the case?
Yeah, I mean, as you called out on this chart specifically, we're starting to waffle between positive net changes and negative, but I think we're still going to see bleed off of those carriers that are on their last dying breath here. You can kind of see too, through the LMI, the transportation capacity here, the logistics managers have not yet said that capacity is in contraction. And so there's still that proof that, hey, there's still ample capacity out there.
Right.
It's just not, the exits are not going to be to the same degree that we saw in 23 going into 24.
Yeah, I think a lot of we did a study on this data that basically said 61, 62-ish% of everybody that left over, there was like a 6-7 month period, had less than 3 years of experience. So you think about this big green bubble that we had of capacity growth. A lot of those people, not a lot of business, not a lot of experience with the market.
But they're the ones that are relying on, call it load boards, and I don't want to say bottom of the barrel freight. It's not the best way to describe it, but it's that kind of, I just am going to be willing to take anything to do it, and then you end up operating your asset at it's such a significant loss, like your ORs in the 110s, 115s. Like, it's not sustainable. You wipe out those that don't have the business sense. I think what it does set up, though, like, you're getting into the point where it's ones that have gone through these cycles that are really now getting to, is it worth it to continue operating? And it's not a quick decision that they make. And I think the BMO data highlights that. I mean, it's more than doubled in the past year, the number of potential or the expectations of bad debt from the bank's lending perspective. And I think you look at that and it's like, everything suggests exits are going to continue happening.
Right.
Again, maybe not to the pace, but it takes a lot long. If you were to look at demand side indicators and supply side indicators, demand side moves a lot faster than what the supply side does especially in the truckload market.
Yeah, and I want to speak to the LTL side a little bit here. Of course, we just did release a new set of data, about 20 data points here to give us a pricing direction index. That's what you're looking at in the white. I get a lot of questions about LTL. I came from LTL, so therefore most of those questions come to me. But I think it's valuable to show this new data set in context with our truckload data set, which is the contract rate per mile in yellow. LTL, of course, not as big of a segment of transportation overall, but it does have nuance. And you can see that reflected here in this chart. You see the white line represents long-haul LTL rate per ton mile for the class band of about 70 to 85. You don't have to know what that is. All you need to know is that prices went up during COVID. They followed the truckload side, you can see there, and then they fell. And they were falling pretty much, with a few month lag based on the truckload space before they jumped up again. This is what I would call the yellow bubble. We just had earnings reports come out and, or not earnings reports, but mid-cycle reports come out with a lot of them reporting downward tonnage movements year over year. And I would say that you have to contextualize this with Estes and, situation last year. They lost service for a while, and also Yellow, of course, the nation's third largest national carrier, kind of injecting some of this freight fuel into a lot of these networks. That appears to be washing out, and I think that we're finally starting to see the LTL side move back into what I would say is connection or conjunction with the truckload space.
All right, question for you, Zach. The lag that you see here, is this just the difference there, just how sticky an LTL contract is and how it's much more like a contract versus the truckload market? Is that why you see this lag in the LTL?
LTL
market?
Is guaranteed capacity.
Yeah.
There's no rejection rate for LTL. And that's because they have to schedule everything. They have to know you're going to, if you schedule something, they're going to go pick it up. And the contracts, therefore, are contracts. They're stickier. They last for 12 months. There's not a lot of mini bidding. Shippers don't like to, and Ryan, back me up on this if I'm wrong. Shippers don't like to go to LTL bids as much. It's not as easy. It represents a smaller portion of their overall transportation spend, so therefore it gets less attention, but it's harder to manage. Therefore, the contracts tend to last longer. It's a little bit stickier. Also, it's just less fragmented. There's less competition there. But I also want to go to you, Mike. You mentioned the maritime sector, kind of the Red Sea continues to be an issue. Spot rates for the international shipping, container shipping, are still relatively high.
Yeah, they're very high, yeah.
And it's like, theoretically, they should have come down a little bit more, considering that people have kind of adapted to it, but they haven't. Do you see this changing this year?
I think they'll go down next year. When you look at those rates, they went up, of course, when the Red Sea took place. And then you would have thought that would have been the peak for the year. But that congestion I talked about earlier in Singapore, that took it up to a whole nother level that was higher than the start of the Red Sea situation. Now, they've come down a little bit seasonally, which is something that you would expect. But on the ocean side of things, you have a lot of capacity coming into the market the next couple of years. I think the latest book of business in terms of capacity coming in, about 8% next year, and then about 6% the year after. Now, what is demand going to do? I mean, a base case probably is your 3%, but it could be worse than that if we're going to have a more protectionist culture and more near sourcing and those things. So I do think you're going to get a situation where just the capacity increase exceeds the demand increase for some time. Now, they are pretty good, the ocean carriers are, of playing games with that capacity and blanking sailings and doing those type of things. And you will see those things as a way to manage, capacity. But the way the alliances, shake up now is there's some more of them, and they're a little bit more operational alliances than necessarily they're all alliances with pricing. At least that's how it's supposed to work.
So we also have the ILA situation still looming in January. What are your thoughts there?
It's still a risk that shippers are looking to avoid. And after the sort of first resolution that we had in October, it wasn't a situation where, okay, shippers want to move everything to the East Coast now. It was sort of stick with the game plan of avoiding the East Coast when that's an option. It's not always an option, but when it is an option to move the goods to the West Coast, and they've sort of continued with that until you get a full resolution in January. And they may discover, some of them that, having the lower sailing time associated with going to the West Coast from, let's say, Asia, which is maybe 2 weeks instead of maybe 4.5 weeks going all the way to the East Coast if you're going through the Panama Canal, that's really just advantageous anyway, even though in total it's more expensive to go that land bridge route to most consumption centers.
Ryan, are you concerned about the January 15?
I'm curious to see what transpires.
Yeah.
I think the union had a bit of the deflation of sales. Governor of Florida said that he'd bring in the National Guard to offload the ships, and
Right, he did.
played some cards.
Right.
But yeah, it's definitely still a risk. Obviously, the negotiations are taking place now, so it's just something to keep on the radar for shippers.
Tony?
I think you're finally getting to a point where they're working through one issue as opposed to multiple issues. I think I don't know if it makes the negotiation any easier or easier to predict, but like they both said, it's a risk. It just feels like as it gets closer, the union to some degree played their cards in the first one and were willing to take the price concession. What? They got 60% pay increases versus 70 or 77, whatever they were looking for. So they've been willing to give some concession. I think the question's going to be around, it remains around the automation and that factor. And does the layman union employee or union worker truly care enough to fight the automation? I think, does that impact their livelihood enough versus, getting the 60+% raise?
Yeah.
And I think that's the interesting part.
Right. So we're coming up on the last 5 minutes here, and I want to get, a hot take from each of you. I want to get your thoughts on, if you had to tell a shipper, carrier, broker, or anybody something about what you expect for 2025 in logistics and transportation supply chain, it can be geopolitical or whatnot. What would be your big thing to say, do this thing or keep this in mind in 2025? Mike Bowdendistel. I'll put you on the spot.
I would say keep in mind that even though there's a lot of bullish sentiment out there, there is still some macroeconomic risks that we should not discount. The tariffs likely to have an inflationary impact on consumers that can reduce spending, that can impact what's going on in dry van and intermodal. So that's a legitimate risk. And Elon Musk heading the department to reduce government spending, along with Vivek, rhymes with cake, Ramaswamy, can be reduced demand also if they pull back too quickly. So there are some risks to demand.
All right. Brian Grody.
My hot take is not a hot take, but a PSA. I would say shippers that do not have relationship with Mexican freight carriers should start building those because I think that the trade lane of Mexico to the U.S. is only going to continue to grow. And I think it's going to impact more and more shipper supply chains as the future goes on.
Now, what would you say to somebody that says, well, I have nothing to do with Mexico. I don't have to worry about it. I get all my goods from Vietnam.
I would say that that's the hot take. I think that we're going to see more of the supply chain move towards these nearshoring partners. Like NAFTA 2.0 is something that Trump ushered in his first term, and I think he's going to expand on that. We've heard talk about, implementing tariffs against Mexico and Canada. I think that's negotiation tactics, but I think those relationships are going to continue to grow.
And so in that, though, like you would see a shifting of transportation networks in the United States, and that would therefore change the way that you've done business with a lot of your transportation providers, correct?
Yeah, absolutely. And I think that's where I say start to maybe build those relationships with carriers that might not be in your current network, but that could be affected by that shift in the supply chain.
All right, Tony.
All right, this is probably a pretty hot take, but it surrounds this broker transparency rule or the potential around it. It will not matter in 2025 because if spot rates go up, carriers won't care about broker transparency. Brokers will feel margin compression in this case. The carrier will be making more money. It will be an afterthought until the cycle changes again.
Oh, I love that take. That is hot. I like
It's a hot
and that's actually that makes a ton of sense.
Yeah.
If rates go up, carriers don't care.
It's only a matter, like they didn't talk about it in 2021, early stages of 2022. It's only been a thing now when rates are at the bottom. If rates move off the bottom, it doesn't become the headache or it isn't as impactful as it is in this environment.
All right. I don't know that I have an extremely different or hot take here, but I get a sense that shippers and carriers and brokers should be ready for the spring this year. And here's why. A specific sector of the economy has been dormant. The home improvement housing sector has been a little dormant. And I don't know, and of course rates and how the mortgage rates influence things, they've been going up inverse to the federal rates here for a bit, and that we'll prove to see how that works out. But I feel like that sector, which has a huge influence in March and April, has a potential to wake up because you've had everybody did their home improvement in COVID, and now you've got this huge recessionary feel in that space for a couple of years. And now guess what? It's time to go back, and you now have another project in your house that's been sitting there for a year and a half.
Yeah.
Hot take, agree, disagree?
Agree. Yeah. I think you also have a supply side issue on the housing market. So you need, I think from a home builder perspective, lower interest rates, they're going to start building if you get them from what they're borrowing at versus what a mortgage rate is. That's a whole different, we could probably go 30 minutes on that itself. But I think what you're saying is if you get home builder sentiment would pick up steam with lower interest rates.
Well, and consumer sentiment right now is at an all-time high.
Yeah.
Right.
So they are very rosy about the future.
Yeah, which I guess a lot of them have already traded down a lot of their goods. Economically speaking, Mike, you're the CPG guy. Any changes there?
Well, there's a big divergence between people who own a lot of stocks and have owned a house that has doubled in value versus the people who don't meet that description. And so you have seen a lot of people trade down, but finally we're at the point where most people are seeing their incomes rise a little faster than inflation after a period of pain. So it's a little.
It's going to catch up.
Yeah, it will, but it's right now just a little bit of sunshine, I think.
Yeah, all right. Well, that will do it for our webinar. Thank you to everyone who has tuned in. And of course, if you're watching this after the holidays, I hope you had a good one. If you're watching this now in the moment, have a great holiday season. Stay tuned to FreightWaves and SONAR, now two separate entities, but we'll still have a partnership throughout the year. So stay tuned for any future freight market updates as they happen, and have a great 2025.